Thank you everyone for joining us for another edition of Smart Money Moves. This is Smart Tax Tips presented by the United Way VITA program, co-hosted by Southwest Louisiana Credit Union. I like to bring in the professionals when we can on topics that, that others are more versed in and have the exact knowledge and the proper information so that we can get to you, our members, and to the community. So we have got with the United Way again for the second year to help us in presenting their information on the VITA program, the Voluntary Income Tax Assistance Program. We have Ms. Lynn Pope that is on with us, and she will be going through this extensive PowerPoint presentation that's very informative and hopefully be able to answer some questions. If you have any today, you'll be able to drop those in the chat session or in the Q&A, and we will do our best to get those answered for you. So we wanted to make sure that you could see our screen because like I said, we were working out some kinks in the beginning, but I think that we got it as long as you can see the screen. It's not important that you see us, it's more important that you hear Ms. Lynn and what she has to say and that you can see the screen. So drop any questions that you may have into the chat session or into the Q&A, and I will do my best to bring those up to Ms. Lynn as we go through the session, and hopefully she'll be able to answer them live for you, or she will give you the resource to get those answers otherwise. So again, we want to thank you for joining us for our second Smart Money Moves of 2022 Zoom workshop. Again, hopefully in the very near future, we'll be able to host these in person. So we're inching closer and closer to that. And so we just thank you for hanging in there with us. So Ms. Lynn, you're muted right now, but I think we're going to go ahead and get started because some of these people may be on their lunch breaks. We just want to thank you for taking time out of your, today is what, Wednesday, to spend some time with us and hanging out with us to get this great information. So Ms. Lynn, I'm going to turn it over to you and you let me know when you're ready for me to click.
Okay, thank you, Ms. Simpson. As she said, this is a presentation brought to you by the United Way of Southwest Louisiana. Our Community Initiatives Manager is Ms. Kimberly Heckard. She's in charge of the program and I am her program coordinator. And I'm going to be discussing the PowerPoint presentation. If you can go to the next screen. Okay.
Is that it?
Yes, thank you. Okay, what is the VITA program? The VITA program is a program that offers free tax help to people who make less than $57,000 and some of our elders, our persons with disabilities and with limited English, people who have a language barrier. VITA is also funded by the IRS and is sponsored by the IRS. And we utilize certified volunteers to provide free basic income tax return preparation with electronic filing to qualified individuals. So VITA is staffed by a lot of volunteers from different colleges and different people from our community. Next slide. Okay, the Internal Revenue Service uses a standard deduction. It is the portion of the income that is not subject to tax that can be used to reduce your tax bill. The amount of your standard deduction is based on your filing status, your age, and whether you're disabled or claim as a dependent on someone else's tax return. So your filing status, your standard deduction depends on your filing status. If you're a single taxpayer, the IRS allows you to earn $12,550 before you have to pay tax on that income. Anything above that will become taxable for single tax filers. Married tax filers who are filing separately, their standard deduction is $12,550. If you're filing head of household are single individuals who have dependents, whether they're minor children or their elderly parents or other people in their household that they're eligible to claim. And their standard deduction is $18,800. And then our married taxpayers who are filing jointly, They get to claim $25,100 before they have to pay taxes on their income. And our qualifying widow or widowers, they also get $25,100. And a qualifying widow is a person who, of course, lost their spouse and they have a dependent child, and they get to claim that status for an additional 2 years after the spouse passes away. And after those 2 years, they will revert to a head of household status. So you see, they would lose about $7,000 on their taxable income that will become taxable. Next slide. All right, I'm sorry, the picture keeps getting in the way of the slide. Okay, taxpayers who cannot take the standard deduction and must itemize. Individuals who are filing as married filing separately, and the other spouse itemizes. So if a married couple, for whatever reason of filing separately, if one spouse itemizes, then the other spouse has to itemize. One spouse can't claim the standard deduction and the other spouse claims to itemize. They both have to itemize if one is trying to file a standard deduction. Also, the non-resident or dual status aliens who are not married to U.S. citizens at the end of the year, they cannot take the standard deduction. And the standard deduction is automatically calculated based on entries in the basic information section of the tax software. So basically, if your total income, let's say it's $50,000, and you get to subtract whatever your standard deduction is from that, and then that difference would be what would be considered taxable income, if you can see that line 11B. So then the computer would look up what your tax is. So that's why the standard deduction is very important, and to know that. Next slide. Okay, the standard deduction versus itemizes. Examples of this standard deduction is types of expenses that generally warrant itemizing deductions. Large out-of-pocket medical and dental expenses. Your medical and dental expenses, usually you get to, if you look at the medical and dental expenses tab right there on the left on the image, you have to multiply that by 10%. So you get 10. So if your medical expenses were, say, $20,000, then you get to claim $2,000. And some other itemized deductions you can claim are your state and local income taxes, your sales taxes, your real estate taxes. That would be your personal property taxes, such as the home that you live in, and maybe your also like your sales tax from purchasing a vehicle or some type of mobile vehicle, and also your mortgage interest and your gifts to charity and certain other miscellaneous deductions. But your gifts to charity is also can be used to reduce. It's also subtracted along with your standard deduction, your gifts to charity. And there is a limit on how much you will receive. It won't be dollar for dollar. Okay, how much do you have to make to file taxes? What is the minimum income to file taxes? First of all, the IRS does set these amounts. However, if you made under these amounts and tax was withheld, like state tax or federal tax, whenever you get your paycheck every week, if they're withholding taxes and you only made $10,000, then you would still want to file. However, if no taxes was withheld and you were single, if you're filing single, meaning it's just you, then if you made under $12,550 and you was under the age of 65, then you won't have to file. And also, if you're over the age of 65, you get a little increase, $14,250. And as you can see, married filing jointly increases up to $25,100 if you're under the age of 65. And if you're over the age of 65, you get a little extra credit. And if both spouses are over the age of 65. And if you're married filing separately, if you make $5, more than $5, you have to file return. And then head of household is $18,800 if you're under 65 and $20,500 if you're over 65. And then you see the qualifying widow. If you're under age 65, it's $25,100. Over age 65, $26,800. But like I said, if you have any taxes withheld from any of your tax documents, you still would want to file, because these numbers make you tax exempt from having to pay taxes on your income. So you would automatically receive that money that was withheld. So that's why you would file. But other than that, if no taxes were withheld, you won't have to file.
This is very good information. So if anybody has any questions, even as she's going through these slides, please post it in the chat and I will go and read those questions and I'll bring them to Ms. Lynn's attention and we'll try to get those answers to you. So please utilize the chat if you have any questions. This is the chance to get your tax questions answered by a professional tax service provider through the United Way. So they can help you, kind of navigate that system, navigate that process, and maybe answer some questions either before you go and have your taxes done, or, if you're just wondering about, how things may turn out or where you can go to get your taxes done. Ms. Lynn will be able to give you those answers and that direction. So make sure that you use the chat if you do have any questions. All right, I'm going to the next slide.
Okay.
Yes?
Yes.
Okay. There we go.
Okay, the earned income tax credit. It is a refundable tax credit for low and moderate income workers. For the year 2021, the earned income credit ranges between $1,500 and $6,700, a little over $6,700. It depends on your income, your filing status, and whether or not you have dependents. The earned income tax credit was established in 1975 to help lower income workers offset Social Security taxes and rising food and energy costs. So if you have children or relatives claimed, your maximum AGI filing single head of household, widowed or married filing separately, you would get zero. If you don't have any children or relatives, your AGI would need to be between 21,000 and 27,000 if you're married, filing as married filing jointly. And then one child, your income cannot exceed 42,000 if you are single head of household, widowed or married filing separately. And if you're married filing jointly, it's 48,000. This is the amount you would need to qualify for the earned income tax credit. And then two dependents, you can't exceed $47,915 if you're single head of household, widowed or married filing separately, and three kids would be $51,464, three dependents, I'm sorry. And then if you're married filing jointly, if you go from the top to the bottom, this is the amounts that your income cannot exceed based on the number of relatives of children, your dependents that you would be claiming. So anything above these amounts, according to each dependent, that would let you know if you would be receiving the earned income tax credit. So it's based on your income basically and your number of your dependents. Okay, the advanced child tax credit is payments that were sent out early from the IRS. It was 50% of your estimated child tax credit that you may properly claim on your 2021 tax return during the 2022 tax filing season. The advanced child tax credit payments are not income and will not be reported as income on your 2020 tax return. The payments are advanced payments of your tax year for 2021 child tax credit. In January 2022, the IRS will send you a letter 6419 to provide the total amount of advanced child tax credit payments that were dispersed to you during 2021. The child and dependent care credit can be worth from 20 to 35% of some or all of your dependent care expenses you pay, depending on your income. So basically, because of the pandemic, we are in unprecedented times now because of the pandemic. The economy was hurt. So what the government decided to do was to advance everyone who qualified their child tax credit. So what we've been seeing on tax returns is some individuals receive maybe $250 to $300 per child. And what that does is when we file their tax returns, normally you would get, it depends, like we just went over, it depended on your income. but we've seen some clients that would normally get $6,600 in a child tax credit for 2 children. Well, throughout the year last year, the IRS issued them checks in the amount of $250 to $300. So this year they're going to get that advanced child tax credit deducted from their return, and they'll only receive the other half this year. So that's very important to let us know whether or not you received it, so it won't delay your return. Because if you say you had not received it and you had received it, and the IRS issue you the full payment, then you would probably be receiving a letter like 8-9 months later saying that you owe the $3,600 advanced child tax credit that you received, that you neglected to inform your tax preparer that you received. So like it says, you're going to receive that letter, and that letter is going to have a breakdown of how many children you received the child tax credit for. It's going to have the amount that you received, and you just let your tax preparer know, and they'll put that on there, and the tax software will definitely reduce your return by that, and you'll be filing a proper tax return. So ensure that you do that if you meet these qualifications. Next slide. Okay, we also have the education tax credit. This is for our full-time or half-time students. You can file what's called the AOTC, the American Opportunity Tax Credit. It's a credit for qualified education expenses paid for an eligible student for the first 4 years of higher education. You can get a maximum annual credit of $2,500 per eligible student. To be eligible to claim the credit, or there's also another credit called a lifetime learning credit. The law requires a taxpayer or dependent to have received a Form 1098-T tuition statement from an eligible education institution, whether domestic or foreign. Make sure you are qualified before claiming the credit, and make sure you keep copies of all documents you use to find out if you qualify and determine the amount of your credit. So yes, like it says, you have the American Opportunity Tax Credit that students can claim. And what it does, it helps to reduce your tax liability, or it's a refundable credit. You can receive extra money back on your return. And also the lifetime learning credit, how that differs is that's for like your students who are obtaining their master's degree or their PhD, or they're just returning after they've completed a 4-year degree. So you can do the lifetime learning credit and receive some credit from that on your return, or you can do the American Opportunity Tax Credit. Okay, and this is a copy of the 1098-T. It lists the filer's name, which would be the institution's employee ID number. That's very important because that's the number that the institution has registered with through the IRS. So that's the number that the IRS is going to use to match that in their database. So what's going to happen is this institution, say for example, if it's Magnisa SWLACU, they're going to send this form to the student, and they're also going to send this form to the IRS. So that's why we have to have this form. The tax preparers have to have this form whenever you're trying to claim this credit. Box number 1 is going to be all of the money that the institution received from the student or the student's parents. And box number 5 is going to be all of the scholarships or grants that was paid on behalf of the student. So basically, if box number 5 is higher than box number 1, and you don't have any out-of-pocket expenses that you can add to box number 1, and out-of-pocket expenses will be such as extra books you may have had to purchase, extra equipment like a laptop or a printer, extra supplies like books and pencils and pens, calculators. Some of the students have to have scientific calculators. Some of the students have to buy like if they're in a culinary arts school, they have to buy their culinary arts uniform or their nursing uniform, their stethoscopes, all their nursing equipment, just anything that you have to purchase to support going to class. Now, room and board is not a deduction. I know we wish it was because it's sky high per semester, but you have to pay for room and board wherever you are. So that's not a deduction. And parking, the fees that you have to buy for the parking pass, that's not a deduction. Meals are not a deduction. So basically, anything that you have to purchase to complete your education is deductible. So like I said, sometimes some students are they have all of these scholarships and it's higher than box one. So then they won't be able to take the credit because they're basically going to school for free. But we do have some of our tax clients who are funding their own education. And so they have out-of-pocket expenses, and box one is normally larger than box five. And so we'll be able to put that on in the system, and they'll be able to qualify for the credit. So that's the form that you would need to be looking for. And it's usually if the institution does not mail you the 1098T, it's normally in the student's portal. They can go into their portal and it'll be there, and they'll be able to download it and turn it in. So I know many of us are probably parents, and we may have some students, some kids that are college students, and we're still maybe claiming them as a dependent. So you would need this form to also file and get the credit on your return if you're claiming the student as your dependent. Okay, next. Okay, determining taxable income and tax. Taxable income is determined by taking the adjusted gross income, the AGI, and subtracting it from your standard deduction, or if you have a small business, your deduction for qualified business income. And a separate worksheet is used to calculate tax for taxpayers who have capital gains, qualifying dividends, and foreign earned income. So we already went over the standard or itemized deductions. And what happened was you get to take either the larger of your standard or your itemized deductions. So we went over the fixed numbers, which were based on your filing status that determined your standard deduction. And we also went over your itemized deductions, which could be things like your medical expenses, your property taxes, your real estate taxes. We went over that. And then the deduction for qualified business income is for our business, like a small business company. And so when we get to the separate worksheet, the capital gains is a deduction that originates from your stock that you have, your all your investments. Like if you purchased your stock for maybe $1,000, and in the year 2021 you sold it for $2,000, then you have $1,000 capital gain. So that would be calculated on a separate worksheet, but then it will be carried to be considered in your AGI. So it will be carried to line 6, where you can see on the image it says capital gain. And then your qualifying dividends are also, if you had a gain on that, that will be calculated on another sheet, and it would be carried to line 3A, where it says qualified dividends. And then also your foreign income as well. Social Security is line 5. When you get to earning close to $25,000 of earned income, or any of these other incomes on there, when that number gets close to $25,000, then your Social Security will become taxable. Also, we see pensions, that's line 4C for our retirees. That is also taxable income. And you see line 1, it says wages and salaries. That's taxable income. So also your losses, if you have losses on your capital gains or on your dividends, that would just be placed on those particular lines as a negative. So for example, if you have wages of say $10,000 and you had capital gains, you purchased your capital gains for, let's say $1,000, but you had to sell it for whatever reason, and it only sold for 500, then you have a $500 loss. So those wages would now, that income from the wages, it would be reduced to $9,500. So that's how all of that plays together. So once we add all that up, all of your credits and your negatives, we come up with a particular number, your adjusted gross income, and then we will subtract that from your standard deduction or your itemized deduction. And then also your line 10 will be your qualified business deduction. And then once all of that is deduced to a certain number, that will become considered your taxable income. I hope I'm not putting you guys to sleep, but I'm just trying to explain it to you line by line. Okay, so here are 5 tips for taxpayers who are deciding whether to file a tax return. Okay, first of all, find out the general reasons to file: your income, your filing status, your age, determine if a taxpayer must file a return. So we went over that. Look at the tax withheld or paid. Did the taxpayer's employer withhold federal tax from their pay? Yes, if they did, definitely you want to file. Look into whether they can claim the earned income credit. Yes, if you earned money, we went over that, so you would qualify for that. Child tax credit or credit for other dependents. Dependent children who are age 17 or older at the end of 2021, well, it should say 17 or younger, they would qualify for the child tax credit, and parents or other qualifying individuals they support, that will be credit for other dependents. And then also your education credits. The taxpayer, their spouse, or their dependent must have been a student enrolled at least half-time for one academic period to qualify. So those are questions to ask whether or not you should file a tax return. So where and how to file your taxes. We have VITA sites here in Lake Charles. We have a site here at the August P. Allen Memorial Complex on Moline Street. It's called the Calcasieu Parish Police Jury, which is right across the street from the post office on Moline Street. We're doing taxes here Monday through Friday from 9 a.m. to 5 p.m. Everyone who wants to file through the VITA site, they must contact 211. From your phone, just dial 211 and they'll set you an appointment. The other sites we have right now, we have a site in DeQuincy. It's opened on select days. We have a site on Sulphur. That site at the Sulphur Library is open on Saturday from 10 a.m. to 1 p.m., 1:30 p.m., 1 or 1:30 p.m. And they're also operational on Thursdays. And we have several little satellite sites, like we have the Most Bluff Senior Center, we have the Iowa Library, and we have a DeRidder location. So as we get more volunteers in, we're looking into being able to staff other sites, but those are the sites this year. And of course, prior to Corona, we had more sites than that, but you know how everything has happened, so everything has kind of have to be reduced. So also places you can file is a website called myfreetaxes.com, or you can utilize a commercial software or a paid preparer if you have a more complicated tax return. Because the VITA sites, we do limited tax preparation. So if you sold property, we're not going to be able to do that. But we do like Schedule E's, which is rental property. We do Schedule C's for our small business owners, such as our Uber drivers, our DoorDash drivers, our, just anyone who has a small business. And of course, if you have a lot of itemized deductions of Schedule A, for example, in 2020, we had a lot of itemized deductions with individuals who were shortchanged by their insurance companies, and they had to come out of pocket and pay for a lot of their expenses. So that's called a casualty loss. So that made their itemized deductions larger than their standard deductions. So that was a scenario where you didn't have to take the standard deduction. You had to do your itemized deduction. So yeah, that's how and where to file your taxes. Next slide. What documents do I need to file? You need all your documents that come from the IRS, anything, any W-2s, which is your wage and earning statements, any 1099s. We have a 1099-R if you're retired, 1099 miscellaneous if you're a contractor or you're or you're self-employed. Any 1098 forms, one of them was the T for education. We have the 1098E, which is your mortgage interest, but that's also on my deduction. So just any tax forms that you have. We're going to need your photo ID and your social security cards for you and your spouse if you're filing jointly. We need social security cards for your dependents. Everyone that's going to be on a tax return, we have to have their social security cards. We need your child care provider information. It's very important that your child care provider gives you their EIN number. That's their employer identification number that they receive from the IRS. We have to have that in order for you to get your child tax credit. You're going to need a voided check if you want direct deposit for your possible refund. Or if you have your bank card that has your routing number and your checking account number on it, that will suffice. Very important, if you have Obamacare insurance, they're going to send you a 1095A form that's going to have some figures on that. We have to have that. If you don't give us that or don't tell us you have that insurance, we're going to get a reject from the IRS. So that's a very important document, your 1095A if you have Obamacare, which is called insurance from the marketplace. And then also if you have last year's return. So in case the numbers don't align with last year, we'll be able to compare and explain to you what happened, what happened with your tax status that year. So those are all the documents you need to file.
So Ms. Lynn, we have a question in the chat and it's asking, can you claim taxes for your home repairs this year, like what the insurance didn't cover?
For example, in order to file the repairs, they have to be unreimbursable repairs from like for example, Hurricane Laura, from a federally declared disaster area. So there's a number that we get off of, it's a FEMA number that's assigned to Hurricane Laura, and you come in and you give us all of your documents. You have to know exactly. It's very time consuming. I'll go into it real shortly, but if you do have unreimbursed damage on your home from any type of hurricane, what you have to do is you have to itemize everything. So say like it's a window, we need to know and of course it's so we talk to people because a lot of people don't understand this. But if the window came with your home and you paid $50,000 for your home, you have to tell us how much you believe the window cost when you purchased the home. That's a number that you're going to have to explain to the IRS. So we put that number in, what it costs you, and then we ask you, okay, so let's say the window cost you $500 when you purchased it, because it's a new home. That's probably what the windows cost, $500. So what was the window valued at after it was damaged? There, right the day before the storm, what was the window worth? So you could say, okay, to replace the window, it probably was still $500. Okay, so after the window was damaged, after the storm, what was the fair market value of it? How much it was worth? Well, it was worth nothing. So it's $0, or it may have been worth $100. I probably could have sold the frame for $100. So you didn't have a $400 loss. So that's how we come about that number. So that's what you get to claim on that. And you have to keep all of these documents. You have to itemize everything that was lost, even like your furniture, even your appliances, your refrigerators. We have to know those 3 items, what it cost you, what it was worth before the storm, what it was worth after the storm. So we can determine your loss. And that's why it's called the casualty loss. So then all of those losses are calculated and it's transferred over to be compared to your standard deduction. So just because you have casualty losses, that don't mean you're going to get to claim them. They have to exceed your standard deduction, which goes by, we went over that, goes by your filing status. So that's what kind of confuses a lot of people. So if you only had like $5,000 of losses that you had to pay from the insurance company, because it doesn't exceed your standard deduction, unfortunately, that's just the way the IRS has it written. But a lot of people we saw, they really didn't get much. So it really helped them. And what it does is it doesn't give you any money back. If you owe taxes, it's going to reduce your tax liability. So say like you may owe $4,000 in taxes. Let's say you had 25, after we did that formula that I just explained to you, your casualty losses was $25,000. Well, all you need to take off that 25,000 is 4,000. So you'll have 21,000 that you can use to offset in the following years. So that's why it's very important to file your casualty losses if they're, very high, because you can carry them over to help reduce your tax liability. So yeah, that's how it works. So let me see, can you claim taxes for home repairs this year? Like what the insurance didn't cover? Okay, because my privacy fence alone was worth more than my deductible. Unfortunately, you can't claim the deductible, but you can claim, like I said, unreimbursable insurance payments. But again, it would have to exceed your standard deduction. So if it doesn't exceed your standard deduction, that doesn't mean throw it away, because there may come a day when you want to sell your home. So when you sell your home, and I know a lot of us probably don't fall in this category, but the government gives you $250,000 that you can make on a profit on your home. So let's say you bought your home for $100,000. We have, after the storm, all of the prices went up, and you're able to sell your home for $400,000 because you fixed it up. It's beautiful, the area. So now you have a $350,000 capital gain. So you get to take 250 off of that. What I started off with 100,000, I said it went for, so you got a $50,000 gain after you subtract the $250,000 that the government gives you. Okay, so that other $50,000, you can use all of these repairs and stuff that you've done on this home that were unreimbursable to offset that $50,000. So always save your documents. I mean, like all your repairs you've done on your home, because if you ever decide to sell your home and you have a capital gain, you can use those unreimbursed and all of those repairs to show this is the money I spent on fixing this house up, and it can reduce you having to pay capital gains on that $50,000, because the capital gain is going to depend on your income. So say like your income puts you in a certain tax bracket. So we have certain tax brackets that start out. They just changed it this year. I used to know it by heart, but they've changed it. So let's say you're in a 15% tax bracket. Well, on that $50,000, you got to pay 15% capital gains. So 5 times 15 is what, $6,000, all right? So that can help you not have to pay that. So, okay, so the next,
I think we talked about the tax sites.
yes, we did.
Okay. Remember, if you have questions, drop them in the chat and we'll try to get those answered.
Okay, and the important tax deadlines. We started doing the taxes January 24th. That's when the IRS set the tax season to open. And you have to have your taxes filed by April 18th, your federal taxes, and by May 15th, your state taxes. And it is best to file both your federal and your state at the same time. And we can definitely do that for you. Any other questions?
Well, we don't have any other questions in our chat. This is the time to drop those in there. If you have anything you want to ask the tax professional, she is on, and she can answer those for you or get you the resource that you need. I just want to say thank you to the United Way, Ms. Lynn Pope, and the VITA program, or VITA program, for the second year of helping us out with getting this valuable information to our members. Thank you for being a partner with us and our credit union members. We try to best serve our members and serve the needs of our community. Thank you for what you do in the community, and especially during this tax time. I know you guys are very, very busy. And we thank you for taking time to share this essential information with us and our members. And want to thank everyone who joined. I don't even know if you can see my face, but thank you to everyone who joined our Zoom workshop today. our second Zoom workshop of 2022. And so I do have a question that just came in, and it says, if you live out of state, but have someone else in another state file your taxes, are you charged out of state fees?
So if you live out of state, but have someone else in another state file your taxes, are you charged out of state fees? That's, I have to have some clarity. So what type of state fees are you referring to? Like state fees for working in another state, but living in a separate state than where you're working? Is that what when you say fees, are you meaning taxes? Are you meaning the fee for them to prepare your taxes? So if we can, I'm kind of confused with that.
Let's see, maybe Miss Alice can give us a little bit of clarity on what type of fees you may be talking about. Are you talking about the fees that the tax preparer just
fee to prepare?
Yeah.
Yeah, that's up to the individual paid preparer what they're going to charge you. But if you like we do for free, as long as they meet the under $57,000 individuals who live out of state. So we won't charge them if they come, and because we do have a virtual program where we send the returns to be prepared by virtual preparers. So yeah, we have some clients that live out of state, and we still prepare their taxes for free. But if you're dealing with a commercial, or a private preparer, and they want to charge the fees, it's up to them to set that. But VITA won't charge any fees.
Okay, we hope that answered your question, Miss Alice. And if anyone else has a question, go ahead and drop that in. And if not, again, we want to thank you for joining us for our second Smart Money Moves Zoom workshop for 2022. We thank you for taking time out of your day to spend this time with us. And we hope that we have helped to provide some insightful information in regards to taxes and tips and tools to help you be successful when you go out and file your taxes this year. And we hope that you will utilize this great service that VITA provides to our community in offering free tax prep services by tax professionals. So thank you again, everyone. We'll have this Zoom posted and shared soon. So again, thank you for joining us, and thank you, Ms. Lynn, and to the VITA program, Ms. Kimberly, for United Way. Thank you for joining us, and we will see everyone on our next edition of Smart Money Moves in March. We hope that you have a wonderful rest of the week, and we hope to see you in one of our branches soon, and also get with the VITA program to help to get your taxes filed for the 2021 taxes filed in 2022. All right, thank you, everyone, and hopefully we'll see you guys soon. Have a great day. Thanks, Ms. Lynn.
All right, thank you. Bye-bye.
Bye-bye.